If you've spent any meaningful time studying currency trends, you've probably heard that central banks move currencies, and that's true. But most traders treat that idea as background noise, something they're aware of but don't really understand well enough to use effectively. And in this video, I want to change that. Central bank actions are not just one input among many. They are the primary engine behind long-run currency trends. Interest rate decisions, liquidity programs, the tone of a press conference, all of these shape capital flows, adjust relative returns between countries, and determine where money wants to go over months and years. And for position traders specifically, this matters more than most people realize. If you're holding trades for weeks or months, you are almost certainly sitting inside a trend that a central bank helped create. Understanding why that trend exists and what could change it is not optional, it's foundational. This video is not about timing announcements or reacting to headlines. It's about building a clear, lasting picture of how central banks operate and why their decisions ripple through currency pairs the way they do. That understanding is what separates traders who react from traders who actually comprehend what they're looking at. Let me start with a clear definition. Central bank actions are the policy decisions and communications that a central bank uses to manage monetary conditions in its economy. The most well-known of these is the interest rate decision, but the full picture includes quantitative easing and tightening, open market operations, direct currency intervention, and critically, every word spoken in public by bank officials. What central bank actions are not is a simple on-off switch for currency direction, and this is where many traders get into trouble. They see a rate hike and immediately assume the currency will strengthen, or they see quantitative easing begin and assume the currency will weaken. That logic is directionally reasonable, but it misses a crucial layer. What actually moves prices is the difference between what the market expected and what actually happened. A fully anticipated rate hike can cause very little movement. A press conference that turns out more cautious than expected can reprice a currency pair significantly, even if no rate change occurred at all. So when I talk about central bank actions, I'm really talking about two things working together: the actual policy decision and the expectation that surrounds it. Both matter. In fact, the gap between them is often where the real price movement lives. It's also worth being clear that central bank actions are not short-term trading signals. They are inputs that shape the macro backdrop, the larger environment in which your trades either have tailwinds or headwinds. That's the lens I want you to hold throughout this video. Currencies don't move randomly. They move because capital flows somewhere. When investors and institutions decide where to allocate money across borders, they are constantly comparing returns, risk, and conditions between countries. A country with rising interest rates offers better returns on its fixed income assets. That makes its currency more attractive to foreign capital. More demand for the currency, and the price tends to reflect that. This is the core logic between why central bank actions matter so much in Forex. Central banks directly influence the returns available in their economies. When they raise rates, they change that comparison. When they expand liquidity through quantitative easing, they reverse it. And this isn't just a textbook relationship. It's a mechanism that plays out in real capital flows, pension funds adjusting bond allocations, institutional traders repositioning around policy cycles, hedge funds expressing macro views through currency exposure. All of that activity adds up to sustained directional pressure on currency pairs. The reason this concept emerged as central to Forex analysis is simple. Forex is fundamentally a market of comparisons. You are never just trading one currency. You're always trading the relationship between two. And central banks are one of the most consistent forces shaping that relationship over time. There's another layer worth mentioning. Central banks also influence something harder to measure: confidence. Their communication shapes what markets believe will happen next. That forward-looking element, what traders call forward guidance, can move currencies before any actual policy change occurs. The market prices in the expected future, not just the present. Traders who understand central banks well don't think about individual announcements in isolation. They think about cycles. A central bank doesn't usually raise rates once and stop. It enters a period of tightening, a sequence of decisions that plays out over months or even years. That cycle has a tone, a pace, and an eventual endpoint. Experienced traders are reading the whole arc, not just the individual data points along the way. They're also reading the relative comparison. A rate hike from the Federal Reserve matters differently depending on what the European Central Bank, the Bank of England, and the Bank of Japan are doing at the same time. If every major central bank is tightening, a single hike has less impact on a pair. If one bank is hiking while another is holding or easing, that divergence is often where the opportunity lies. Another thing experienced traders focus on is tone. After a rate decision, there's usually a statement and a press conference. The words used, whether the bank signals concern about inflation, whether it sounds confident or uncertain, whether it characterizes the next move as data dependent or predetermined, all of that is parsed carefully. A single word like patient or gradual can shift the market's read on the rate path. This isn't about obsessing over every syllable. It's about understanding that central bank communication is a deliberate act. These institutions know that markets are listening. Their language is chosen carefully, so paying attention to the tone, not just the decision, is part of accurately reading the macro backdrop. The overall mental framework here is, what is the central bank's current direction? How committed are they to it? And how does that compare to what's happening elsewhere? The most common mistake I see is treating central bank decisions as news events to trade rather than macro inputs to understand. Traders watch the announcement, see a rate hike, and look for an immediate entry. And when the currency doesn't move the way they expected or reverses after an initial spike, they're confused. What went wrong isn't usually their execution, it's their framework. The issue is that by the time the announcement happens, much of the expected move has often already occurred. Markets are forward-looking. If a rate hike was broadly anticipated for weeks, the currency may have already repriced. The announcement then becomes a confirmation of what the market already believed. And when expectations are confirmed, the reaction can be muted or even reversed. It's what some traders call buy the rumor and sell the news. Another breakdown point is treating each announcement as independent. Central bank policy unfolds over long periods. A single decision, viewed in isolation, rarely tells you much. What matters is the policy trend, the direction of travel, and how that compares with other central banks. There's also a tendency to oversimplify the relationship between rates and currency direction. Higher rates should strengthen a currency, and often do, over time. But the relationship isn't mechanical. If a country is raising rates in response to runaway inflation, that's a different signal than raising rates from a position of strength. The context changes the interpretation. And the deeper issue is that most traders learn the rule, rate hikes strengthen currencies, without learning the reasoning behind it. When they understand the reasoning, the exceptions start to make sense. For position trading, central bank analysis is one of the most valuable inputs available, and here's why. Position trading is about identifying and holding directional trends over weeks and months, and those trends don't appear out of nowhere. They're typically rooted in real macro differences between economies, differences in growth, inflation, and monetary policy. Understanding what central banks are doing gives you a framework for understanding why a trend might have genuine staying power. When a central bank is in a clear tightening cycle and a comparable economy is holding or easing, that divergence can sustain directional pressure on a currency pair for an extended period. And that's exactly the kind of environment a position trader wants to be aligned with. You're not fighting the macro drop, you're working with it. That said, central bank analysis does not tell you when to enter or exit a trade. It tells you the context. It tells you whether there's a macro tailwind or headwind. The actual decision of when to act and at what level requires a separate technical layer of analysis. Those two inputs work together. Neither replaces the other. It's also worth being clear about what central bank analysis doesn't help with. It's not useful for short-term timing. Volatility around announcements is unpredictable. Spreads widen and prices can move sharply in either direction before settling. For position traders, that's not where the edge is. The edge is understanding the larger directional forces and positioning accordingly with patience. Central bank actions are not a trading strategy, they're a lens. When you understand how interest rate decisions, liquidity programs, and policy communication shape capital flows, you start to see currency trends differently. You're not just watching price move, you're understanding why it moves. And that distinction matters more than most traders give it credit for. For position trading, this understanding is part of a larger decision-making framework. You're building a picture. What is the macro environment? What are the central banks signaling? And is the direction of the trend I'm considering aligned with those forces or working against them? That kind of clarity takes time to develop. It requires sitting with the material, watching how policy cycles unfold, and learning to read the tone of central bank communication as well as the decisions themselves. There are no shortcuts here, but the patience is worth it. The full written guide behind this video, Central Bank Actions in Forex Trading and Introduction, is available on the Position Forex website. The link is in the description. It goes deeper into the specific tools central banks use, how forward guidance shapes market expectations, and how to think about risk around high volatility policy events. If this video gave you a clearer picture of the concept, the article will help you build out the full framework at your own pace. And until next time, best year trading.